Hey everyone, me Kevin here. So I've been thinking a lot about the real estate market and what could the future of the real estate market hold. And there's this really interesting question that came up, and it's taken me quite a while to do research on this because it's pretty in depth. But we've got all the answers that we're going to summarize here. So the claim: housing doubled in the 1970s as interest rates doubled because wages went up. And so I thought this was really interesting because really the conclusion there is inflation will make investors more rich. And in theory, we've heard this idea before that real estate, and I've said this too, that real estate over time tends to return a little bit of a higher rate than whatever inflation is, which in some sense makes people look at real estate and say, hey, well then real estate must be an asset class that does well during inflationary times. So we did a little bit of looking into this and tried thinking, okay, well, where could this go wrong, or is it correct? And the answer was quite interesting. Hey, Gabe, what's our sponsor today? Extra. If you want to also get into real estate, remember, you need a great credit score. So go check out metkevin.com/extra to build your credit score with a debit card that works like a credit card. You apply it to your existing bank account. You don't have to open any new accounts. You sign up for that extra debit card, and boom, they will lend you money overnight, over the business night, reimburse themselves, and then report your payments to the credit bureaus as if you had paid off a credit card to help build your credit score. Go to metkevin.com/extra to learn more. Okay, so let's get into this. Here's what we found. So what did housing prices do? Well, housing prices from when we had these inflationary periods in the 1970s, housing prices went from about $23,000 per home to about $73,000, or about 2.7x. And wages over that same time did go up about 2.3x during 10 years. And what was interesting was if we overlaid what the average sale price of a home was in the United States with inflation, what we found was every time we had higher levels of inflation or a recession, real estate prices did slow their growth, but they did not necessarily turn negative. See, in the early 70s, real estate prices came down with the recession of the early 70s, but they only disinflated in 74, in 80, and 82. All three of these being recessions where real estate prices actually went up while we were in a recession and while we had high inflation. What happened, though, was as inflation went up and as interest rates went up, we just saw the rate of price growth slow. So prices basically went up less quickly. For example, if we look up year over year, look back rather, year over year, home prices are up about 20%. Well, now we've got this high inflationary environment. Interest rates have gone up a bit. I would expect to have large headwinds against real estate prices going into 2023 and maybe 2024. But we'll talk more about projections and is it possible that real estate prices could actually turn negative. We'll talk about that. But first, I think one of the big conclusions, and this is sort of a pre-conclusion because there's a danger here we're going to talk about. One of the conclusions was from some of this initial research was that, sure, it is true that housing prices doubled while rates were going up and inflation was high. But we were able to correlate that inflation slows home price growth or leads to a short-term decline in the event there's a recession. And if there's a recession, prices don't necessarily have to fall in real estate. Remember, recessions don't necessarily mean bear markets. Recessions just mean that consumers spent less, even just fractionally less, than they did the year before 2 quarters in a row. So a technical recession does not necessarily mean you have a 2008 style housing bust. But there's a little bit of a problem with looking back at the 70s. And unfortunately, this is where the data gets a little bit more complicated, where it's extremely difficult to parse this out. But we're going to come to an ultimate conclusion here in just a moment. But we've got to look at the danger. So here's the danger. Fannie Mae, Freddie Mac, Ginnie Mae, and to some degree FHA, although FHA was created during the New Deal in the 1930s. Most of these, the government-sponsored enterprises, they actually started loosening and simplifying requirements to get into real estate in the 70s. So in the early 70s to the late 70s, this is when we actually popularized the 30-year mortgage. And, well, back in before the 1930s, nobody was even doing amortized loans. Home loans were like short-term loans, just like a regular kind of car loan almost. 30-year mortgage really got popularized after the 50s and then almost mainstream in the 70s. Take a look at what else happened in the 50s. In 1956, we got private mortgage insurance. Now, here's what private mortgage insurance is. Every time you buy a property with less than 20% down, you have to pay something known as private mortgage insurance. Basically, think about it like this. Let's say, and this is just an easy way, an easy trick to calculate this. Let's say a lender went to you and said, hey, I can get you a home loan right now for 3.5%. And you're like, that sounds great. I like it. I'll take it. But I want to put down 15% instead of 20%. So let's assume this is 20% down. Well, they might say, okay, no problem. You're going to pay a 0.5% extra in PMI to be able to put down that 15%. Well, now it's as if your interest rate, because they're calculated the same way, though they're calculated independently, it's as if your interest rate is 4%. So it was a little more expensive, but you're able to get into home ownership for less money down. And usually the biggest impediment for people getting into a home isn't so much the interest rate, it's usually the down payment. And so we didn't actually get private mortgage insurance to really enable loans under 20% down until 1956. And it wasn't until 1971, the start of this boom cycle, that we got 5% down loans. And so now the data really gets skewed, because now we take a generation of home ownership between the 1930s and 50s, where everybody's putting 20% down, or they're just getting used to the idea of a 30-year fixed rate, fully amortized loan. Now you get to the 70s and they say, hey, why don't we just do 5% down, which again just became a thing in 1971, at the same time as we were essentially at the bottom of real estate prices here in 1971. And so the question is it possible that real estate prices could have stayed above this black line? The black line here meaning growth, anything below the black line meaning prices actually fell year over year, right? Is it possible that prices went up every single year? Because remember, this is not a chart of accumulating prices. Accumulating prices look a lot more like this when you look into the past. This is just the year over year gain, that blue line there. And so why did they not turn negative? Well, it's entirely possible that home prices didn't actually turn negative because we were now introducing a whole new cohort of buyers who, yeah, wages were going up, but that didn't necessarily mean people had 20% down payments. But you had more people able to buy homes with 5% down and potentially afford more expensive homes. Yes, because when wages go up, you can qualify for more. But that does you no good if you're not saving. So now Americans were able to be consumers at the same time as homeowners with very low down payments. So now this really brings us to today, 2022. And so what's the potential going forward? Well, the big issue that we're facing right now is quite simple. We're facing high inflation and a rising interest rate environment. In the environment we're in right now, we know that the 10-year Treasury bond, which is something that mortgage rates tend to follow, the 10-year Treasury bond has gone to about 2%. And at about 2%, we have mortgage rates of about 4%. And it's entirely expected that the 10-year will eventually go to 3%, which will mean mortgage rates will be somewhere around 5%. Now, if this happens, so this is the 10-year here, if this happens, we would expect at least an additional 10% headwind in real estate prices, plus the fact that we just recently hit 4%. So we're really looking at about a 2% interest rate shock in a matter of probably about 6 months. And that's because interest rates went from probably somewhere around 2.88, and they might go as high as around 4.88. This 2% shock can translate to about a 20% decline in real estate prices. Now, that doesn't necessarily mean that prices are going to come down 20%, because prices could actually still go up 20% versus this down 20%. Now you zero out and prices stay flat. That explains why sometimes you could actually just see prices go flat and not actually go negative, even during recessions. Now, there's something unique, though, that's happened since the Russia-Ukraine crisis, and that is that the 10-year Treasury bond has actually become a safe haven asset. People who are concerned about the uncertainty of emerging markets or equities like stocks or investing in other countries or even other currencies are fleeing, at least in some part, to the 10-year Treasury or other Treasury bonds. And when people flee to Treasury bonds, what they do is they actually drive the yield on the 10-year down. So even though we recently hit 2%, we're expecting to hit 3%, right now we're trading around 1.88. So we've actually dropped a little bit. So my expectation is while the Russia-Ukraine crisis evolves, we probably won't see massive headwinds to real estate. Maybe a little bit of a slowing, but probably not massive headwinds. When we start getting back to this 10-year treasury, and maybe we get peace in Ukraine, which let's pray to God that happens, and everything chillaxes with Russia, it's quite possible that we could start that path running back to that 3% 10-year. And that could potentially be a short-term peak in real estate pricing. Now, does that necessarily mean we're heading into a recession? No. I think the biggest thing that could drive us into a recession is actually an overly aggressive Federal Reserve, where the Federal Reserve decides to rug pull us and says, we've got to fight inflation. And one way that they can fight inflation is by making sure that rates are so high, so quick, that we end up crashing stocks, we end up reducing aggregate demand, we force a recession, and inflation evaporates. If that happens and people start looking back and going, oh my gosh, real estate prices are falling at the same time as rates are going up, that's possibly when we could see some real estate headwinds. Now, how much would we actually expect in the worst case scenario that the Fed has to force a recession? I wouldn't expect probably anything more than 10, 15% of a correction, if that. And that's solely because the only driver for real estate prices heading down, in my opinion, would be either fear of the Fed, which I expect would be temporary or transitory, and these rates going up. And once the inflation is sort of squeezed out of the system through a potential recession, I do think real estate is an excellent long-term investment. And I don't know if it makes sense to sell and pay the capital gains taxes and try to time the market in real estate unless you have a better opportunity to come up or a better opportunity coming up. And this is why I always resort back to in my programs on building your wealth, like my real estate investing course link down below, or my do-it-yourself property management course link down below. There's a reason why I always resort back to finding the wedge. See, the beautiful thing about finding the wedge deal, or wedge deals in whatever market you're in, whether it's multifamily or single family, is your goal is, if this has been our market, this last bit here, let's say this was March of 20, and this has been the market here, is even if we do end up having up to those 10, 20% headwinds, I wouldn't be surprised if we ended up having some form of a future real estate cycle like this, where we have a little bit of a depressed cycle here, and maybe this ends up looking something like a 10 to 20% decline at most, rather than something more severe like a 30 to 35% decline. And again, the reason for this, why no longer am I expecting something like this to potentially happen? Because of the Russia-Ukraine crisis. The Federal Reserve is much less likely to force that recession, to get inflation completely squeezed out of the system, because when we have war happening and geopolitical concerns, there's too much uncertainty, and the last thing the Fed wants to do is deal with a recession while there's a war happening. It's unlikely. Now, if this war ends quickly, hey, maybe we have to reanalyze and look at that discussion again. But right now, I expect the Fed to be pretty chill, be accepting of higher inflation for longer, be pretty dang patient. This could change pretty quickly, but right now I'm not horribly concerned that this is in our future. This could be in our future. So we'll see what happens, and I'll keep you updated. But these are my latest thoughts on real estate. Make sure to check out Extra via the link down below and the programs on building your wealth link down below. And folks, we'll see you in the next one. Thanks. Bye.